Hi guys, very good morning all of you. Welcome back. So today we are going to start with a very important area for financial reporting ACCA paper 7, and this is also equally important for SBR and Diploma in IFRS. Okay. So as far as the introduction to the topic and the basics are concerned, it is same for all the three papers, whether you are preparing for FR or SBR or Diploma in IFRS, the basics will be same. When we go to the problems level, solving problems, then maybe probably in SBR, we'll deal with little advanced problems. Having said that, more or less, the introduction and basic problems will be same. So today, let us see the basics of, introduction to what is group. Why do we need consolidated financial statements? What is a business combination? In group, what types of entities are there? And the meanings of important definitions like control, power, decision making, all these things we'll discuss in the introduction class. Shall we start? Also, in group accounting, there are so many accounting standards involved. It is not just one accounting standard, it is a bundle of accounting standards, as you can see on the screen. To begin with, we'll start with business combinations, which is our standard number 3. International Financial Reporting Standard 3 deals with business combinations, followed by consolidation. Consolidated financial statements is discussed in IFRS 10. Then also we have IAS 28, IAS 11, IAS 12, IAS 27. This 28 I have repeated, so I am deleting it because it is already there above. Okay, now let us start with consolidated financial statements. Okay, so there are some 3-4 bullet points on the screen. Can you read that? Just have a look at it, what it is.
Yes.
Shruti, if you are there, can you read this?
Hello, can you hear me?
Yes.
Okay. Understanding IFRS 10. First one, IFRS 10, Consolidated Financial Statement, outlines the requirements for the preparation and presentation of CFS, requiring entities to consolidate entities it controls.
Okay. So here, if you look at it, there are two entities. There are two entities. Did you observe there are two entities? So what these two entities are? This is one entity. This is one entity. So this is parent. This is subsidiary. So IFRS 10 is asking you, requiring the parents to consolidate subsidiaries. Now, what is a parent? What is a subsidiary? When can I say that the other company is my subsidiary? All these things will come in the due course. But first, try to understand it is the responsibility of the parent company to consolidate the financials of subsidiary company. It is the responsibility of parent company because IFRS 10 is casting the responsibility on the parent. Dear entity, if you are controlling another entity, it is your responsibility to prepare CFS. So what are the requirements? How do I do that? Now, if someone asks, Pavan, I understand I need to prepare consolidated financial statements because I have a subsidiary, but I do not know the process. How that is to be done? Simple. Read IFRS 10. Consolidation process is given in IFRS 10. So this is the first bullet point. Let us continue. Go ahead, please.
Control requires exposure or rights to variable returns and the ability to affect those returns through power over an investee.
Very important definition. We'll discuss in detail about what is this control. We'll discuss in detail. So basically, there are three conditions. Pavan, when can I say that the other company is my subsidiary? There are three conditions. One is you should have control over the other entity. For example, by way of holding more than 50% of the share capital, which gives you voting rights. Or two, by way of having a shareholder agreement such that you will appoint the directors of the other company. you will reappoint or remove or fix the remuneration of the directors of the other entity. So for example, in Indian context, I'll give you one example. Look at Reliance Industries and look at Reliance Jio. Reliance Industries is the parent company, Reliance Jio is a subsidiary. So either Reliance Industries will have more than 50% of the share capital in Reliance Jio, and that is one way of controlling it. Or imagine if their control is only, if their stake is only 30% or 35%, even then you can control the other entity by way of contract. There can be a contract. So the contract says that whoever is going to be the director in Reliance Jio, a subsidiary company, whoever is going to be the director, who will conduct interview? Reliance Jio, Reliance Industries. The parent company will appoint directors of the subsidiary. The parent company will remove the directors of subsidiaries. So if your director's collar is in my hand, obviously your collar is in my hand. Try to understand. If your company's directors are in my hand, your company is in my hand, no? And when I invest money in your company, I invest in equity shares, not in debt instruments. Maybe I can invest in a combination of equity and debt, but voting rights will come only if I invest in equity, no? I might not be able to get voting rights if I invest in debt in your company. For example, I have given a loan to you, $1 billion loan I have given. That need not give me one voting right also. Even if I buy one ordinary share in your company, I'll get one voting right. So normally voting rights will come through investment in ordinary shares. So the holding company or the parent company has invested money in the equity instruments of subsidiary. The moment I say equity instrument of the subsidiary, what you need to understand? One, returns will vary. Equity instruments will not have any fixed dividends or fixed growth rates. So when I invest money in a company, share appreciation, like, the market price of the share, market value of the share might vary. Capital appreciation might vary. Dividend rate might vary. So this is what we call, if I invest money in a company, if I am the investor, if I invest in ordinary shares, I have exposure. What is the meaning of exposure? Risk. I have exposure. Or I have rights to variable returns. Returns are not fixed. If I invest money in, say, for example, in a fixed deposit in JP Morgan Chase Bank, the percentage of interest I get is fixed. But if I invest money in ordinary share, I will have variable returns. So one, I have power. Power. What is that power? Voting rights is an power. Voting rights is one power. Shareholder agreement to appoint directors is one power. So I have power. Point number one. Point number two, I have exposure to variable returns. Point number two. Point number three, the power what I have, am I intending to exercise it? Am I able to exercise it? My ability to exercise the power, if it is not absolute, I do not control you. I have voting rights, but is it practically possible for me to exercise voting rights? That is also a criteria. So if these three conditions are satisfied, then we can say that yes, A limited controls B limited. The moment you say yes, A limited controls B limited, then B limited is subsidiary, A limited is parent. A limited is called holding company, B limited is called subsidiary company. So to claim that the other company is your subsidiary, you should exercise control. That means one, power; two, variable rights, exposure to variable returns; three, the ability to exercise the power for, to make decisions and all. This is, you might ask, there are only two lines in this bloody bullet point. Why you have given this big lecture on the two bullet point, on the two lines, one bullet point? Because that is explained in detail in next paragraph. In one of the next paragraphs, we'll discuss in detail what is control and all. Then I will not, discuss everything because already I have explained. So That is about second bullet point. Now, let us continue with third bullet point.
The parent and subsidiaries accounts will be combined to present a single economic entity in accordance with IFRS 10.
So underline single economic entity. Oh my God. Single economic entity. Do you remember in your, maybe earlier foundation, when you are learning the basics of accounting, you might have come across one particular phrase, which is substance over form. What's wrong with this? So what is that? Substance over form. Okay, all IFRS are based on this particular principle called substance over form. You'll ask, what is substance over form? Look here carefully. There is a company called Jaguar Land Rover in United Kingdom. There is a company called Tata Motors in India. This Tata Motors is a holding company. Jaguar Land Rover is subsidiary company. Okay, because Tata Motors has acquired Jaguar Land Rover. Now, JLR, Jaguar Land Rover, is a subsidiary of Tata Motors. Okay, this is old story. This is not nothing new we are inventing. For the purpose of law, to comply with the Companies Act in UK, to comply with the income tax regulations in UK, to comply with any of the terms and conditions of any debt covenants or any agreements, JLR is completely a separate legal entity. A separate legal entity. So in the eyes of law, JLR is a separate legal entity. That is what we call legal form. So legally, what is the legal form? Legal form says JLR is a separate entity. But from the shareholder's point of view, the person who invested money in Tata Motors, for example, Pavan has shares in Tata Motors. So my money is in Tata Motors, and that money is flown, is transferred to JLR. So who invested in JLR? Indirectly, Pavan. Pavan invested in Tata Motors. Tata Motors invested in JLR, means Pavan invested in JLR, no? So from the point of view of Pavan, JLR is not a separate entity. It is extension of Tata Motors for me. It is extension, or it is an integral part of Tata Motors. So Pavan will say, no, I never agree if JLR is a separate, if you tell JLR is a separate entity. Maybe for the purpose of Companies Act or for the purpose of income tax regulations, JLR could be a separate entity. That is the legal form. But the economic reality is that, both put together is a combined entity for me. Both put together is a combined entity for me. This is what we call economic reality. This is what we call economic reality. Or this is what we call substance. This is what we call economic reality, or this is what we call substance. So these two companies, JLR and Tata Motors, the legal form, when you look at the legal form, they are two different entities. But the economic reality is that it is one single entity. So when you prepare financial statements of Tata Motors, which includes the financial information of Jaguar Land Rover, you are presenting consolidated financial statements of the group as a whole. You are presenting consolidated financial statements of group as a whole. When you prepare the financial statements of the group, you are not giving any weight to the separate legal entity status of both the companies. You are considering that as a single economic entity. That is one group for you. So look here, this bullet point says the parent and subsidiaries accounts will be combined to present a single economic entity in accordance with IFRS 10. Now you might ask, okay, I have prepared consolidated financial statements. What advantage it gives to me? Why consolidated financial statements are required? That is given in the next bullet point. Overall, consolidated financial statements provide a more accurate, comprehensive view of a group's financial performance. And it improves transparency in accounting, transparency in financial reporting, comparability, and it enables a good, effective decision making. So to improve transparency, to enhance the comparability, and then to give you insights or information for effective, better informed decisions, consolidated financial statements are required. So it is important during consolidation that, oh my God, one more thing, reporting periods match. Now, as I told you, Jaguar Land Rover is in UK. They might follow financial year, which is 30th June every year, the 30th June 2024. But Tata Motors, as I told you, is in India. They follow 31st March. Now, the question is, this entity is having July to June financial year. This entity is having April to March financial year. So there are two entities. One entity is having April to March financial year. Another entity is having July to June financial year. How will I consolidate? The reporting periods are different. The reporting periods, the financial year is ending, starting on so-and-so date, ending on so-and-so date, which is different. Ideally, subsidiary company has to follow holding company reporting period. Ideally, subsidiary company has to follow holding company financial year. But subsidiary company has to comply with law of that particular country, no? Now, Jaguar Land Rover cannot go to UK government and say, no, I have my parent company in India, I'll follow their reporting period. No, UK government will not allow. Then what am I supposed to do? Simple. IFRS says, no worries. Till the time the difference between the financial year of holding company and financial year of subsidiary, if the gap, if the difference is 2-3 months, I will allow. 1 month difference, bad end, chalo. 2 months difference, no problem. 3 months difference, no problem. If it is more than 3 months, I will not agree. So IFRS said there can be a difference between the reporting period of holding company and subsidiary company till the time the gap, the difference is not exceeding, is not greater than 3 months. If it is greater than 3 months, I'll not allow. But I'll tell you one thing practically, okay? I have seen enough group accounts in my life. I have done enough consolidations in my life. Normally what happens, whatever the reporting period of subsidiary is, if holding company's reporting period is 31st March, simple, you prepare one set of financial statements of subsidiary ending on that particular day for consolidation purpose, which makes your life easy. So difference in reporting period is hypothetical. Maybe in exceptional cases it will be there, but it will not disturb consolidation every day. Point number one. Point number two. Pawan sir, imagine if I am having 31st March, if I am having 31st March in case of one company, and if I'm having 36 in case of another company, there is 3 months difference. Now, from 31/3 to 36, in this 3 months, if there are any significant accounting transactions or events, in this particular 3 months, if there is any significant accounting transactions or events, adjustments are to be made to the financial statements of subsidiary to give effect for this, significant events that are happening in this 3 months. Now, practically, instead of, having a separate reporting period and then making adjustments, Don't you think preparing another set of financial statements for subsidiary makes more sense? But IFRS is not asking you, you have to prepare subsidiary financial statements ending on the same date like how holding company is ending. No, there is no requirement like that. It can be 3 months difference, but in that 3 months, whatever the significant transactions are happening in subsidiary company, the financial statements should comprise that. That means adjust financial statements with these events. Adjust financial statements with these events. That is what they are saying. So what is the first one? The difference must be no longer than 3 months. Okay. What is the second one? Adjustments are made for the effects of significant transactions in the intervening period. What is that? That means that 3 months, 1 month, 2 months, 3 months, whatever it is. The length of the reporting periods and any difference in reporting, the length of reporting period and any difference in reporting dates must be the same from period to period. Means you should follow consistency. Pavan sir, last year, subsidiary company financial year is ending on this date. Holding company financial year is ending on this date. The gap between the reporting period is 1 month. This year also, you should follow the same dates and same gap. Next year also, you should follow the same dates and same gap. This is something similar to accounting policies are to be followed consistently. Similarly, something like that. Here, these reporting periods and the dates on which the financial statements are drawn shall be consistent year to year. You understand? Note. Very, very, very important thing. But in classroom, whether you're doing SBR or Diploma in IFRS or FR, maybe this particular point is not that important, but in reality, it is very, very, very important. Now, holding company and subsidiary company, there is, possibility that both of them have different accounting policies. For example, if your subsidiary company is in US, then for inventory valuation, you can follow LIFO. But in India or in UK, in many countries in Europe, LIFO is not allowed. So those students who are doing CMA US course or CPA course, they will have problems based on LIFO. But if you are doing any global course, which is basically ACCA based, or if you are doing any domestic course in countries like India, you will never see inventory valuation based on LIFO because your accounting standard prohibits LIFO. Based on your accounting standard, you need to follow, in India, you need to follow, what is that? LIFO. So, sorry, FIFO. You cannot follow LIFO. You can follow, if it is India or if it is UK, you'll follow FIFO or you'll follow weighted average method. Now, one company has valued inventory based on LIFO, another company valued inventory based on weighted average method. Now, this company inventory is $1 million. This company inventory is $1 million. Can you add that two and say the total inventory of the group entity is $2 million? No, these are not comparable because the first 1 million of first company is based on one accounting policy, one method. Another 1 million of second company inventory is based on another cost equation, another accounting policy, another method. So you cannot add A plus B is equal to C because they are not comparable now. They're not comparable. So the standard says, accounting standard 10 says, if the accounting policies are different, my dear accountant, please ensure that you follow same accounting policy. Now the question is, Pavan sir, what if the accounting framework or the geography in which the subsidiary company is operating, what if they do not allow that accounting policy? For example, holding company is in US and US company follows LIFO. Subsidiary company is in UK. In UK, LIFO is not allowed. So how can they have uniform accounting policies? If that is the case, you follow one accounting policy for holding company, one accounting policy for subsidiary company, no problem. But adjustments are to be made to the financials of subsidiary before doing consolidation. That means the subsidiary company is located in UK. You are following FIFO or weighted average method. Had it been LIFO, what would be the value of inventory? You have to recalculate it for consolidation purpose. What is the summary? Simple. The conclusion is there should be uniformity in accounting policies. Is the reason. In reality, what happens, In reality, what happens, Simple. Parent company will publish a book, a manual called, called Group Accounting Policies. There will be an accounting manual. So you might have got 100 subsidiary companies in 40 countries, 50 countries, 100 countries. The parent of the group, they will publish one accounting policies book and it will distribute to all the subsidiaries, which subsidiary has to comply with. If your country is not allowing for your financial reporting purpose, you follow accounting policy, whatever your country accepts. But for consolidation, you have to rework matching with the parent company and you need to give financials. You understand it? See the note. Uniform accounting policies should be used. Adjustments must be made where members of group use different accounting policies so that their financial statements are suitable for consolidation. You understand? So much of theory, isn't it? Isn't it? We'll see some 3-4 more bullet points theory, and after that we'll start with some basic problems so that it creates more, curiosity and interest in you. Okay, so the next para says consolidation process. Put a star mark, very important. Okay, so this is important area. So can you read these bullet points, please?
Yeah. Consolidation process. Combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries.
Very good. Continue.
Offset or eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary. That is IFRS 3 business combinations explains how to account for any related goodwill.
Very good. Continue.
Eliminate in full intra-group assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group, that is profits or losses resulting from intra-group transactions that are recognized in assets such as inventory and fixed assets are eliminated in full.
Very good. So these 3 bullet points define how, what is the process in which the consolidated financial statements are to be prepared. To a very big extent, we are speaking about balance sheet. We are speaking about statement of financial position in these 3 bullet points. We are not speaking more about P&L. P&L part, income statement part, that we'll see later. That also will come, but that we'll see later. Consolidation. Even in financial reporting also, majority is SOFP. Even income statement is prepared to help balance sheet preparation only. So I'll give you 1 to 2 minutes of time. I'll just shut my mouth. All of you read these 3 bullet points once again. Try to understand it. Then I will tell you what it is. Read these 3 bullet points, all of you. Are you done?
Yes, sir.
Okay. Now look here. Okay. So what they're saying here, combine. What is the meaning of combine? Add. Like items. What are the like items? Assets of holding company, assets of subsidiary. Liabilities of holding, liabilities of subsidiary. Equity of holding, equity of subsidiary. Income of holding, income of subsidiary. Expenses of holding, expenses of subsidiary. Cash flows of holding, cash flows of subsidiary. Add them, combine. So here a basic equation, what I tell in my style is A plus B is equal to C. Or you can remember holding company plus subsidiary company is consolidated financial statement. That means if trade receivables of one company is $1 million, trade receivables of one company is $1 million, trade receivables of another company is $2 million. So for consolidation purpose, it is $3 million. So your revenue plus my revenue is our revenue. Your expenses plus my expenses is equal to our expenses. Your assets plus my assets is equal to our assets. So like items are to be added. Your plant and machinery, $6 million. My plant and machinery, $4 million. Our plant and machinery put together is $10 million. This is what they are saying. Is this clear? Combine like items, assets, liabilities, equity, income, expenses, cash flows of the parent with the subsidiaries numbers. Now, look at this example one. Assume the parent company owns 100% of subsidiary. The following are the individual financial statements of parent and subsidiary as of December 31st, 2022. Parent company numbers are given, subsidiary numbers are given, consolidated financial statement numbers are given. Now, here, what is the assets of parent company? 500,000. What is the assets of subsidiary company? 300,000. What is consolidated financial statement assets? Simple. A plus B is equal to C. 500,000 plus 300,000 is equal to 800,000. If you cannot do that, you can use calculator also, or you can use Excel sheet also. Sir, after using calculator and Excel sheet also, I am unable to get 800,000. Then there is no option for you. Sorry. So this number plus this number is equal to this number. Now, can you do it with all the line items of this particular table? In this particular table, do it for all the numbers. Assets, A plus B is equal to C. Liabilities, A plus B is equal to C. Equity, A plus B is equal to C. Revenue, A plus B is equal to C. Expenses, A plus B is equal to C. Net income, A plus B is equal to C. Investment, A plus B is equal to C. Everywhere you might have got super duper answers, except this is one area, equity, tadan, tadan, tadan. This is one area, investment. In this two items, wicket will be bold. All the others are okay. For all the others, A plus B is equal to C. But in this two, A plus B is not equal to C. Do you understand this? Did you observe this difference? 5 plus 3 is equal to 8. Okay. 100 plus 50 is equal to 150. Okay. In case of revenue, 300 plus 150, 450. Okay. Expenses, 200 plus 100, 300. Okay. Net income, 100 plus 50, 150. Okay. But, how come 400,000 plus 250,000, it should be 650,000? No. How come it is 400,000? It is not 450. I'm sorry. Typing mistake. It should be 400. 400,000 plus 250,000 should be 650. But why it is only 400? 250 plus 0 should be 250. Why it is 0? Why it is 0? Why it is 0? All the other lines are based on bullet point 1, combine line items. These two lines are based on this one. Offset, eliminate. What to eliminate? Carrying amount of parent investment. What is carrying amount of parent investment? If you look at it, what is carrying amount of parent investment? Can I say this is carrying amount of parent investment? Eliminate carrying amount of parent investment. Eliminate carrying amount of parent investment. With what? With equity of the subsidiary. Simple. The meaning of it is, dear subsidiary, you have 250,000 equity share capital. Yes, sir. Who gave you? Parent company. So in the books of subsidiary, it will be shown as equity share capital. In the books of parent company, it appears as investment, but both them are same, no? My investment in your equity shares, my investment in your equity shares. So these two are to be eliminated. Otherwise, it will be double accounting figure. You understand? So what we are doing here, if you look at it, let me change this. Okay, if you look at it, explanation. Parent company invested $250,000 in the ordinary shares of subsidiary company. Parent company invested $250,000 in ordinary shares of subsidiary company. 1. This appears as investment in the books of parent. Agreed? This appears as equity capital in the books of subsidiary. These two numbers are mirror images. IFRS says eliminate them. That's all. That is all, Your Honor. Now, if you are smart enough, you might get it out here. What if this number and this number are not matching? Parent company need not, or practically speaking, cannot invest in subsidiary company based on face value, no? Face value can be $1. The market price of the share can be $100, no? If face value of share is $1, need not be necessarily, the market price of the share will be same as face value. Definitely, it will not be same as face value. It will be much higher. Now, what if the subsidiary company's capital is 250,000, but to acquire that, holding company had to invest 600,000 based on market value. Now, how will you eliminate it? How will you eliminate it? If you eliminate it, the basic accounting equation will not match. This is what we say goodwill. Parent company invested $600,000 in a company to acquire net assets worth 250,000. That means I have put 350,000 more, which is called goodwill. That's all. That is what in theory they said here. If at all there is any goodwill, that means if the carrying amount of the investment in parent company books is not matching with the equity of the subsidiary company, there may be a goodwill or bargain purchase. Then how to account for the same, IFRS 3 will tell you. That's all. Then there are so many transactions between parent company and subsidiary company. Okay. There are so many transactions. Like parent company has given loan, subsidiary company borrowed money. So in one books, it is shown loan given, account receivable. In another company books, it is loan you're taken, borrowed. That is liability. I have sold goods to you. In my books, it is sales. In your books, it is purchases. I have given dividend to you. In my books, it is dividend paid. In your books, it is dividend income. I have provided technology to you. You paid royalty to me. For you, it is royalty expense. For me, it is royalty income. I have given loan to you, so you are paying interest to me. For you, it is interest expense. For me, it is interest income. I have rendered some consulting services or engineering services to you, for which I have generated an invoice and you are paying money to me. For you, it is consultancy charges paid expense. For me, it is consultancy income. You are my sales agent. You booked sales for me. I have given sales commission. For you, it is sales commission income. For me, it is sales commission expense. You understand? These are called intra-group. Intra means within. Within the group, there are certain assets and liabilities. Within the group, there are certain income and expenses. Within the group, there are certain cash flows. For one entity, it is asset. Another entity, it is liability. One entity, it is income. Another entity, it is expense. One entity, it is cash inflow. Another entity, it is cash outflow. These are to be eliminated. These are to be eliminated. Now you might ask, why they are to be eliminated? Simple. Look here. Look here. Holding company is a separate legal entity, correct? Okay. It has given loan to subsidiary company. In holding company books, loan given. In subsidiary company books, loans borrowed. Till this, okay. Now, when you prepare consolidated financial statement, same amount appears as loan given and loans borrowed. How awkward this is, how weird, how ridiculous it is. Isn't it stupidity? That means what you are doing, you are saying, hey, you know what? I have borrowed money. From whom? Myself. I have given a loan. To whom? Myself. That means I have to pay $1 million to me. I have an asset, I have a liability. What is that? My own money. Don't you think it is heights of stupidity? That is the reason accounting standard saying, IFRS 10 is saying, beta, intra-group assets liabilities, intra-group equity, intra-group income expenses, intra-group cash flows are to be eliminated in full. That's it. Can it result in profit or loss? Yes. It might result in profit or loss. Why? I sold goods to you. My cost is $80. I have sold it at $100 to you. So your purchases will be $100. My sales will be $100. But in this sales $100, $20 profit is there. How to account for it? Don't worry. Business combinations, IFRS will tell you everything. Even IFRS 10 has a super solid explanation for that. IFRS 10 deals with it. Don't worry, not IFRS 3, IFRS 10 deals with it. We'll learn in detail. So try to understand the consolidation process. Close your eyes. A plus B is equal to C. Combine line items. Okay, very good. Step 1. Step 2. Eliminate parent company's investment with the subsidiary company's equity. Very good. 3. Any intra-group transactions like assets, liabilities, equity, income, expenses, cash flows, eliminate in full. resultant goodwill in step 2, resultant profits in step 3, what to do? Guidance is given. Don't worry about it. This consolidation process. This is what example is. Then I have given one problem for you. Basic consolidation. Problem number 1 is your homework. Small problem. So whatever the example I have given now, same I have given here in problem number 1 with the solution. Okay, you have to deal with this. Can you? So any doubts in whatever we have discussed so far?